Hey everyone, S. Dot here with Gold Rush Trading Academy. And a lot of people that we talk to know what stocks are and what the stock market does. But once we get into it, not many know what options trading, and what an option contract is. So this short video is going to get us into what an option actually is. What is an option contract? An option contract gives the buyer a right or option, not an obligation, to buy or sell 100 shares of a particular stock at a predetermined and agreed price. That's called the strike, at or before a specified time, which is called the expiration. Types of options contracts, two types of contracts, which are calls and puts. Calls give you the ability to buy the shares at the specified price, and puts allow you to sell the shares at the specified price. The pricing of these are determined by the amount of time left on the contract and the price of the stock that the contract involves. Time is the extrinsic value, and the price per share of the stock is compared to the contract is the intrinsic value. Intrinsic value, or how much in the money your contract is, or what the value of your contract would be at expiration, which is for calls, stock price minus strike price equals intrinsic value. Example, stock ABCD, price is $100, contract strike was $95. The intrinsic value equals $5, 100 minus 95. For puts, it's the strike price minus stock price equals intrinsic value. ABCD price is $100, contract strike is $110, intrinsic value equals $10, 110 minus $100. Extrinsic value is based on the time until the contract expires and implied volatility. The longer until the contract expires, the better chance the stock price has to meet or surpass the strike price. Intrinsic value is the sum of the time and the volatility. Time value plus volatility value equals intrinsic value, where time value is the time left on the contract and volatility value is the amount the share price might move based on market, economic, company events, or any other outside circumstances. The higher the IV, the larger the predicted move. The lower the IV, the smaller the predicted move. So here's a real world example. Say you are currently looking to buy a house and you find a great house that isn't perfect, but close to it for around $100,000. You still want time to look for other houses, so you offer the current owner $5,000 to hold it for you until the end of the month. You have the right, but not the obligation at the end of the month to buy this house at $100,000. If you decide not to buy it, the owner gets to keep your $5,000 you paid for the contract. In this scenario, $100,000 is your strike price. The last day of the month is your expiration date, and $5,000 is the premium or cost you paid for the contract. So what could the results of this contract be? Winning scenario. Within a month that you continue to look for other houses, it is announced that a large company is moving their headquarters to the town the house under contract is in. This influx of personnel increases the housing demand, which increases the price of the house to $200,000. You now have two options. You can buy the house at the already agreed upon price of $100,000 plus the $5,000 holding deposit. This would be considered exercising the contract. Now owning a $200,000 house for $100,000, you have $95,000 in equity right off the bat. Or option two, you don't have the $100,000 or found a house that you like more. You can now sell that contract you hold to another person for $100,000. And they will then buy the house from the original owner for $100,000 for the total agreed upon price of $200,000. So this would essentially net you $95,000 after the $5,000 hold that you put on. So those are your two winning options. Now, the losing scenario would be within the month, the town announces that they are building a new waste treatment plant right across the street from this house. The value of the house drops down to $50,000. So now you decide not to buy that house because you had a contract for $100,000 and you would have to pay that if you exercise the contract. So now you lose a $5,000 hold fee that you put in, but thanks to you not buying the house immediately for $100,000, you didn't lose the $50,000 off the bat. So that's where the contract would have saved you. If this kind of content you enjoyed, please hit the like and subscribe button. We're going to try to put these out more often and get to the basics of options trading. Thanks, everyone.